Ago, one of the largest banks on earth, the Industrial and Commercial Bank of China, announced that it was shutting down paper gold trading for everyday customers. The change takes effect on July 24th, 2026. It wasn't alone. The Postal Savings Bank of China moved first, then Ping An Bank. Others followed. Some of the biggest banks in the world all ended the same product, paper gold trading, within the same short window of time. The official explanation is simple. Gold has become too volatile. It reached an all-time high earlier this year before suffering a sharp correction, and many retail investors lost money. According to the banks, removing paper gold trading protects ordinary people from taking excessive risks. That explanation is convenient. I don't think it's the real reason. I think July 24th may become the day China begins discovering what gold is actually worth. And I believe the price of gold displayed on your screen every day may not be the real price at all. To understand why, we have to travel back nearly 60 years to a room inside the Bank of England, where in March 1968, the floor literally collapsed beneath the weight of stacked gold bars. What happened inside that room may be about to happen again. There is a room inside the Bank of England where gold bars are weighed before changing hands. In March 1968, the floor gave way, not because the building was old, not because it had been neglected. It collapsed because too much gold had been piled onto it. The United States had been flying gold from Fort Knox to London on military aircraft faster than workers could weigh it and sell it. The bars kept arriving until the floor itself failed under the weight. Why would America empty its own vaults? Because the most powerful governments in the world had made a promise they could no longer keep, and the rest of the world realized it at almost exactly the same moment. After World War II, the global financial system rested on one simple promise. The US dollar would become the world's reserve currency, and every foreign government holding dollars could exchange them for gold at a fixed price of $35 per ounce. $35. 1 ounce. Anytime. As long as America kept that promise, holding dollars was effectively the same as holding gold. So the world accumulated dollars. But through the 1950s and 1960s, the United States spent far more money than it collected in taxes. Wars, social programs, overseas military commitments, and the responsibilities of being the world's superpower all required enormous spending. To finance those obligations, more dollars were created. The problem was obvious. The supply of dollars kept increasing, while the amount of gold sitting inside American vaults remained essentially unchanged. Foreign governments could do the math. If twice as many dollars existed while the same amount of gold backed them, then every dollar represented less gold than America had promised. Officially, gold still cost $35 per ounce. Realistically, it was worth much more. So governments did the logical thing. They handed over dollars and demanded gold. America's gold reserves began disappearing. To stop the outflow, the United States and 7 European allies created the London Gold Pool in 1961. Its mission was straightforward. Whenever the market tried pushing gold above $35, the participating central banks sold their own gold into the market to force the price back down. Think about what that really meant. They weren't selling because they wanted to. They were sacrificing the most valuable asset they owned simply to preserve confidence in paper money. For several years, it worked. Then France quietly left the arrangement. Instead of helping suppress gold prices, France began exchanging its dollars for physical gold. Other countries soon followed. What began as a trickle became a run. Everyone wanted metal before the vaults were empty. Normally, the gold pool sold about 5 tons in an average week. On March 8, 1968, it sold 100 tons in a single day. During the final week alone, nearly 1,000 tons of gold left the system. That was the week the weighing room floor collapsed. On March 14th, London shut the gold market completely. After the weekend, governments admitted defeat. From that point onward, 2 different prices existed. The official price remained $35 per ounce between governments. The free market price immediately jumped above $40 and continued climbing. One price existed on paper, the other existed in reality. 3 years later, in August 1971, President Nixon ended dollar convertibility into gold altogether. Within a decade, gold traded above $850 per ounce. Remember that sequence. First, governments defended a paper price. Then, demand for physical gold overwhelmed the system. Then, two separate prices emerged. Finally, an entirely new monetary system replaced the old one. Now, look carefully at what China is doing today. To understand it, we first need to understand paper gold. Despite the name, paper gold isn't complicated. When most people buy gold today, almost no physical gold changes hands. Instead, they buy a contract. That contract says they own 1 ounce of gold and can later sell the contract at the current market price. The actual gold supposedly sits somewhere else inside a vault. Most investors never ask for delivery. They don't want to store it, they don't want insurance, they simply want exposure to the price. Banks understand this, and that changes everything. If almost nobody asks for the physical metal, then institutions can issue far more paper claims than actual gold bars exist. The same ounce can support multiple promises, 10 contracts, 20, sometimes far more. The system only breaks if everyone demands delivery simultaneously, and historically, almost nobody does. Now ask the critical question: what happens to price when paper claims vastly outnumber the real metal? Prices are determined by supply and demand. But if the market believes 10 ounces exist because 10 contracts are trading, even though only 1 real ounce actually exists, then perceived supply becomes far larger than physical supply. Greater apparent supply suppresses price. Every additional paper contract increases supply without creating a single new ounce of gold. In London and New York, where the world's benchmark gold prices are established, the overwhelming majority of transactions are exactly these paper contracts. Most settle in cash. Very little physical gold actually moves. Even more remarkable, nobody truly knows how many paper claims exist relative to actual metal. Think about that. One of the world's most important prices is determined by a market that cannot accurately tell you how much of the underlying asset actually exists. That should sound familiar. It's remarkably similar to 1968. A paper price, a physical reality. Two very different things. You might argue that this is only speculation. Fair enough. So, how would we know whether physical gold is actually worth more than the paper price? There are two simple tests. The first is to watch for price separation. In a healthy market, a claim on an asset and the asset itself should cost virtually the same. When confidence disappears, physical assets begin trading at premiums over paper claims. We've already seen this happen in silver. At one point, physical silver sold for roughly 40% more than the paper price. The same metal, the same day, two different prices. Gold hasn't reached that point yet, but neither had gold in early 1968. The second test is even stronger. Ignore what institutions say. Watch what they do. If you believe the paper price understated the real value of gold, what would you do? You would quietly reduce your paper assets and accumulate physical metal. That is exactly what central banks have been doing. During the first quarter of this year alone, central banks purchased approximately 244 tons of gold, the strongest first quarter ever recorded. They have now bought more than 200 tons in 10 of the past 11 quarters. Even more interesting, the World Gold Council estimates that a significant portion of those purchases are never officially reported. Gold is being bought. The public simply isn't told about all of it. At the same time, many central banks have been reducing their holdings of U.S. Treasury securities. Read that behavior carefully. The institutions that once trusted paper promises are increasingly exchanging those promises for physical metal. Actions speak far louder than press releases. Now let's make this personal, because this isn't merely a story about gold traders. It's a story about your purchasing power. Take 1976. Gold traded around $125 per ounce. An average American home cost about $44,000, or roughly 350 ounces of gold. A new car cost about $5,400, around 43 ounces. A week's groceries for a family of four were about $62. 1 ounce of gold bought roughly 2 weeks of food. Gasoline cost around 61 cents per gallon. 1 ounce purchased nearly 200 gallons. Now compare that with today. The average house costs around $425,000. That sounds almost 10 times more expensive. Yet, measured in gold, that same house costs only about 112 ounces. Cars are dramatically more expensive in dollars, yet require fewer ounces of gold than they did decades ago. Groceries cost many times more in dollars, but 1 ounce of gold now buys months of groceries instead of weeks. Gasoline costs several dollars per gallon, but 1 ounce of gold purchases far more fuel than it once did. Measured in dollars, everything became expensive. Measured in gold, most things became cheaper. The house didn't suddenly become 10 times more valuable. The dollar became less valuable. Gold simply preserved purchasing power. And here's the important point. Every one of those comparisons uses today's quoted paper price for gold. If the physical price eventually separates from the paper price, then gold's ability to preserve purchasing power has been understated all along. Which brings us back to China. China isn't banning gold. Chinese citizens remain free to buy physical bullion. What China is eliminating is paper gold. Instead, it is building a system centered on physical delivery. The Shanghai Gold Exchange requires actual gold to move from seller to buyer, real bars, real vaults, real settlement. You cannot endlessly create synthetic supply when physical delivery is mandatory. That process is called price discovery. It measures what buyers are truly willing to pay for real metal rather than paper promises. International participation will increasingly flow through Hong Kong, providing overseas investors with access to physically settled trading. But perhaps the most revealing development is happening underground. Hong Kong is expanding its gold vault capacity from roughly 200 tons to more than 2,000 tons, a tenfold increase. Paper contracts require no storage, digital promises occupy no warehouse. You build vaults only if you expect physical gold to arrive. That investment tells its own story. China appears to be preparing for a world where physical gold matters more than paper claims. In 1968, the run on gold happened unexpectedly. Today's transition looks deliberate. Reduce dependence on paper markets, increase physical settlement, allow genuine supply and demand to determine price. Perhaps most remarkable of all, China hinted at this years ago. Back in 2014, the head of the Shanghai Gold Exchange openly declared that gold was consumed in the East but priced in the West, and that once China gained greater influence over the global gold market, the real price would eventually be discovered. More than a decade later, the infrastructure is in place, the vaults are built, the policies are changing, and July 24th marks another step in that process. So think one last time about that room inside the Bank of England. In 1968, workers believed they were defending the system. They moved 1,000 tons of gold in a desperate effort to preserve confidence. Instead, the floor collapsed beneath them. This time, something feels different. Gold is once again moving from west to east. But instead of defending the old system, many of the world's largest institutions appear to be preparing for a new one. If this interpretation is correct, two things should happen next. First, the gap between paper gold and physical gold should widen, just as we briefly witnessed in silver. Second, central banks should continue replacing paper assets with physical gold. If both trends accelerate, then history may not simply be repeating itself. It may be rhyming. Because in the end, this isn't really a story about gold. It's a story about trust. Trust in paper, trust in governments, trust in financial promises. History has shown that once enough people begin questioning those promises, the price everyone believed was real can change almost overnight. The only question is whether July 24th, 2026 will be remembered as another ordinary policy change or the moment the world quietly began discovering the true price of gold.